We are again around that time of the week where we bring to you our webinars which are packed full of information and some fun Q&A. At 10 a.m. we have a webinar on rising inflation, how to make your money work harder for you. We have another webinar at 10 a.m. on the iThought PMS ecosystem, which will cover everything that you need to know about us. At 11 a.m., we have a webinar exclusively for all the amazing women out there, a candid conversation-based webinar which will help you chart out your wealth creation journey. If you would like to be a part of our webinars, don't forget to register. You can find the registration links in the description. See you all there.
Friends, today I'm going to talk to you about my experiences. The topic is success in value investing. It's probably not the best time to even use that phrase, but that's the phrase that we have used successfully for over 3 decades. In between, several points in time like the present emerged. 1999 was one time, 2007 was a second, and we have 2020 as the third, when success and value investing did not seem to be traveling together. But the beauty is, a few years after this phase, whatever we believed were stocks that fitted the bill of value investing transformed into growth stocks. So effectively, what had happened in the lives of investors like us is that when the world was sneering at value investing, we were able to buy businesses very, very cheap at a point in their business cycle where growth was looking soft. The future was not looking as promising in those sectors and themes as they looked in other topical areas. And then, over the next few years, the very boring themes turned into growth stories. After that, the rest is history. So, success in value investing essentially is about buying companies when they are very, very attractively valued, holding them till growth starts happening, and then gradually moving out of them when growth looks very, very predictable and consistent. This runs very, very contrary to the popular ways of investing, where people think that you can buy a team or a company or a sector just before growth is about to take off, or just after growth has taken off. But my experience is most of the time it doesn't happen. Whereas buying companies when they are great value is far simpler. You get a long runway of time to buy those companies, and it's not very difficult to hold on to them because you haven't overpaid. And when growth starts happening, you start seeing it very clearly. The difference between growth investing and value investing is only gestation. But the reward is probably higher in value investing. And that is why I believe there still is ample merit in seeking success in value investing. My approach has always been to catch a theme which is out of favor, probably more than one theme, and build a portfolio around those themes. Effectively, you have to look at a theme which will do well in the future, but is doing nothing in the present. And then build a portfolio of stocks around the theme. I tried this approach many times, but what is significant is that in 2009, I tried to build a portfolio which had 3 or 4 teams where we could hold those companies for the next 7-8 years, did not need to disturb the portfolio, and were confident that those teams had reasonably strong runway of growth. Importantly, we also had some basic visibility. How do we ensure that the teams don't backfire? For that, we decided to buy businesses which are intrinsically strong, where the balance sheets don't have debt, which are businesses that throw out reasonable cash, pay decent dividends, and are likely to see their fortunes turn when the macro environment becomes favorable to them. And that's how this portfolio started. I continued to invest to that philosophy in that particular portfolio, and after 6-7 years, while I was comparing the other styles which I had pursued, found that this portfolio actually had done very well without much of volatility. That's when I started reformulating what had worked and productizing that idea. And then you had the bull run of 17 and 18. So we did nothing. We just created the idea and kept it. The themes were there. We decided what would be the minimum size of a company to buy, what sort of expectations to set, what kind of investment gestation we'll need, because we had a 10-year track record in studying how this worked. Finally, when we wrapped it up into a product, it is that product that became Solitaire. When we pick teams, put them into a product to an investment philosophy, and then create a portfolio around these themes, what happens is that the volatility is significantly lower. We are able to buy different teams and put them together. Some teams work out faster. Even if 1 or 2 teams are seeing adversity, overall the portfolio does not give us sleepless nights. I really like this idea for the simple reason that even in my portfolio, I would like to allocate a significant amount of money to this kind of an investment approach, keep investing whenever I get money from dividends or from other sources, and building this portfolio into a significant part of my portfolio. So I started putting my own money also into Solitaire, and I keep doing that. And I find that it gives a lot of opportunity to invest into various themes when they are out of favor. It helps me to scale up those ideas, gives more investment runway to put in money, and is also recognized very quickly by the market when a theme opens up. So when we have bought something and we are waiting and the market sees the merit of the theme, then the value runs up very fast. So the fact that a theme is ignored by the market doesn't bother us, because it is only one of the themes sitting in the portfolio. We have multiple themes. Some theme or other gets into favor. 1 or 2 themes remain completely out of favor. So we are able to focus our investing on the out of favor themes, while the themes that come into favor stabilize the portfolio. This is what I believe will give us a lot of risk-taking ability in the future. We will be able to buy newer themes when they are out of favor, and the gestation in these themes will be reasonable. So in 3 to 4 years, each theme will play out one after the other. So that in essence has been why we took Solitaire as our first product idea in the PMS, and that is why I am putting my money into this PMS, and that is also why I am confident that when economic growth returns after this phase of contraction, the themes which we are betting on will probably grow faster than the broader economy, and that really would be the time when we will see the rich rewards flowing in.